Good morning, ladies and gentlemen. Welcome to today's webinar, Real-Time Daily Trading Ideas. 5 days, 5 traders. Today we will be speaking about trading ideas, strategies, market screenings, and we'll be answering your questions. Before we can start with the actual webinar, we will briefly present the risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. If you are unexperienced with our products or trading in general, please do get used to the trading environment by using a demo account. If you have any questions regarding that, just give us a call and we will be there to answer them all. Right, this is the schedule for the week. Today it's Jay's turn. And many of you probably know the reasoning as to why they're trading with us, but just as a quick reminder, we do have best index and Forex offerings with spreads of just 0.8 or 0.6 pips respectively. Alright, enough of me for the moment. I'm passing over the screen to Mr. Jay Medro.
Good morning, Rolf. Good morning, Dees. Good morning, Mark. Good morning, everybody. All right, let's rock and roll. Let's get going. What do we have cooking? It's been a while. It's been a while, my friend. I was out giving seminars, and we have an exciting morning. But let's try to recall the last time we were talking about a trade opportunity. That was on April the 15th, so more than a couple of weeks ago. And at the time, I was looking to potentially long the euro versus the yen that week. And my reasoning was that we had an expectation for better economic numbers, and a short positioning favored a potential short squeeze in the euro, i.e. a short positioning of the buy side. On the yen side, we were expecting weaker economic numbers and a continued risk-on environment on the back of improved Chinese data. At the time, the risk to the trade was that the EU numbers would come in weaker than expected and or a sentiment change in the market, which would then cause yen inflows. And what happened was that on Thursday, we were getting numbers and we were hitting into the potential long at 126. Now, two caveats. I'm not trying to cop out, but to enter a trade on Thursday means the party is over. Monday is construction day, or most of the party is over. And on Friday, we have square up day. So it's very, very unfortunate if the trade idea hasn't panned out by Thursday into the number. And this is what happened. Right here, you can see the economic number, and we can see that a little dash, that's the 126. That is not a long trade. Why? Because the econ numbers were worse than expected. We had, especially in Germany, a worse than expected manufacturing PMI. Even though the services PMI beat, we have the situation that the EU is depending on Germany as an export champion to continue to do what they do best, and that is exporting. And so the manufacturing data for Germany came in worse, and then the flash manufacturing PMI and flash services for the Eurozone at whole came in worse than expected on top of it. So that is not a long whatsoever, okay? So one needs to keep in mind that the economic data is always the driver for institutional money to be shifting from A to B, and that is a shift towards the short side, not towards the long side. Good. Now, what did we have going on this morning? We woke up and, well, actually last night, Mr. Trump already started tweeting in one of his magical moments. I don't know what this guy is thinking, but he's trying to pressure the Chinese, who need to keep face by threatening more tariffs by Friday afternoon or Friday close of business. Or Friday, by Friday, he's threatening more tariffs. And so we woke up to a wonderful risk-off moment in the markets. This is being sarcastic, obviously. We wiped out all of Friday's Goldilocks gains, and we're back to square one. We have these renewed tariff threats potentially shedding, according to Bloomberg Research, 1.5% of Chinese GDP growth if they were to be put in full effect, as according to his threatening tweet. It's interesting how you make global policy via tweeting these days. But anywho, the Chinese equities reacted accordingly. And please recall that we up till now have played globally a recovery of the economic growth worldwide in the second half of 2019. So not only in the US, but also in the rest of the world, ROW. If this were not to materialize, all bets are off. Sell in May and go away all of a sudden would look like it's working out once more. This seasonality effect, which makes, I have no logical argument why that should take place, by the way, but I'm just saying, if the tariffs were to be put in place, we have a major problem on our hands, major problems. UK Prime Minister May is optimistic about a deal with Labour Party. They are not, and is up to 100 PMs threatening to veto whatever she comes up with. So recall that on Friday, I'm trying to jump ahead, sorry. Recall that on Friday we had the pound closing on its high. It was super strong because a hard Brexit was off the table according to the markets. And also recall that today we have UK May Day holiday, so London is not open. So it's easier to manipulate the markets a bit, but we'll have to see, especially tomorrow. Tomorrow, the Japanese are coming back into the market, and we'll have to see how the talks are going. Jesus Christ, amongst May and Labour. Hang on, I'm switching WhatsApp off. This is driving me nuts. Sorry, guys. All right. On a side note, I keep an eye on the Australian mortgage market and the most leveraged banks, and Westpac is the most levered bank to the Australian housing market. And this morning they came in reporting a 24% drop in H1 profits, statutory profits. The index reacted because it's heavily weighted towards miners, but also towards the financials. And so the ASX 200 was down, and obviously the stock is down as well. People's Bank of China is lowering their reserve requirement to small and medium-sized banks. Funny how this is popping up on the radar this morning after the tweet by Mr. Trump. And that's going to release roughly 280 billion effective May 15th renminbi into the market. So again, the Chinese are trying to prop up their financial system once more, but nowhere near the Chinese Accord 2.0, as some on Twitter alluded to. It's not possible because in 2008, the Chinese credit stimulus was very favorable to the rest of the world economic development, but measuring it versus today versus back then, it's called a base effect, and the base effects are huge, and there's no way, regardless of what the Chinese are ever doing, ever, based on the base effects, mathematically impossible to have a similar impact. All right, so keep that in the back of our mind. Obviously, if the trade war causes the Chinese to shed GDP growth, it's going to be very detrimental to Australia, New Zealand, the rest of the world, Europe, the US, everybody. Well done, Trump. Well done. WTI was down almost 3% overnight, but the $60 per barrel in WTI front month actually held for now. Copper obviously pressured and gold supported. Gold, the only thing that sucks is that in this risk-off mode that we currently have, the dollar is seeing inflows as well because the rest of the world is doing so bad. So that is a bit of a headwind in terms of gold, but I am long still. Tuesday, we have the RBA cash rate decision, 6:30 German Frankfurt time. There's a cut expected by 25 basis points to 1.25%. And on Wednesday, we have the RBNZ cash rate decision expected to remain at 1.75. Both are very, very close around the 50% handle. I prepared some slides for you guys on that, so we'll look at that in a sec. Here you can see the beautiful tweet, and then last evening, and then you can see the futures reaction of the spoos. That's the nickname for the S&P 500, how we gap down, traded lower, and are, well, I can't see it right now, but we haven't recovered. That gap is not closed yet, and we'll have to see if it is to get, if there is a chance to close it at all. As you can see on the bottom left-hand side here, we had some inflows into the Japanese yen, and we had some outflows at the time out of the Aussie, the New Zealand, and the Canadian. So the dividends were hurting, and Canadian dollar was hurting as well based on the weaker oil price. Also very crappy data out of Canada last week. Aussie. So on Tuesday morning, we have the rate statement, and the market is pricing in a 59% probability of no cut and a hold of 1.5%. Now I let you in on something. I am of a differing opinion. My opinion is that they may cut. The problem is the CPI, the Consumer Price Index, is sharply lower to the lowest it's been in 3 years. The annual rate is down to 1.3% from 1.8%, and that is a mile away from the RBA target. And by law, they are required to worry about inflation. That is their #1 requirement, to get a handle on inflation. And that is basically they are required to cut. Now, some of the banks in the research teams are proposing that employment has increased by a better than expected 25.7, and the unemployment rate is slightly up to 5 from 4.9, but not to worry, they argue. And this increase in employment will lead to an increase in wages, and that will help the inflation rate. Well, what one needs to know is that in Australia, the inflation is only reported once a quarter. So now is the opportunity for the RBA to do something about inflation. Now, yes, we know there's a vote coming up. Parliament is voting. Yes, we know they have a green budget. So the politicians are making tremendous promises. Vote for us and we'll spend money for you and on you, dear voter. That's all happening in the background. But I need to make a decision. My decision is, and my opinion is that I think they're going to cut. I could be completely wrong. It's very close. The market is 60-40 right now, and it's breathing as we speak. But what about New Zealand? New Zealand is 24 hours later, May 8th. The market is pricing in a 53 probability of a 25 basis point cut to 1.5. So RBA, 60% no cut. RBNZ, 53% for a cut. That's the picture right now. The last unemployment report saw slower job growth and lower participation rate, and marginal decline in the unemployment rate. So here you have the change in employment going negative on the bottom left-hand side, and on the bottom right-hand side, you can see GDP annual growth rate coming off tremendously. Yeah? Look at summer of 2016 versus now January of 19, we have come off significantly. Also, please recall that in the March central bank meeting, the RBNZ shifted from neutral to dovish. They said their next move will likely to be a cut on softer economic growth in their largest trade partners, of which there are Australia, China, and Europe, and slower domestic growth. So have a look at GDP growth in Australia, have a look at GDP growth in China, which, if these tariffs were to be implemented in full by Trump and the Americans, would shave off 1.5% of GDP growth. That's a catastrophe, and Europe is not looking that much better yet. So on top of it, in New Zealand, we have slower domestic growth. So it doesn't look that great. I can see why they would potentially cut, but I don't think they're going to cut. Could be completely wrong on that, of course, but that's my opinion. I think the Australians are going to cut, and I think the Kiwis are not going to cut. Anywho, then on Friday over in Canada, we have employment change, and that's expected to come in a bit better at plus 15K. Versus that dismal minus 7.2 thousand last time, bottom left-hand corner here. The unemployment rate is expected to remain unchanged at 5.8%. So here we see the Canadian labor force participation rate. It's another digit that we look at that's quite important, and that's expected to remain unchanged at 65.7. On top of it, the RBC notes that wages for permanent workers was continuing to rise in March at an annual rate of 2.3%. Okay, good. So low unemployment rate, not at full employment. Yeah, 5.8%. They still have a bit of unemployment in their economy. And workers continuing in terms of their wages, we see some growth at 2.3. That's good. But that growth is diverging from the central bank's preferred measure for wage growth, and that's called the wage common measure, and that's running at 2% annually right now. And here I added for you a definition of what the BOC, how they come about their wage common, and what they look at to get that number. So we have a divergence here, and that's quite interesting for me. because I'll keep an eye on that. I'm very eager to see what inflationary pressures are on the wage component side for the Canadian economy. So last week we had pretty dismal GDP numbers. It wasn't too good what we saw last week. And this week, Friday, Thursday, we have trade that's expected to come in a little bit better. And then Friday, we have employment numbers expected to come in a little bit better. If oil market were to hold, then I would be quite eager to long the Canadian dollar towards the second half of the week, but I would have to see something very weak, which will be given to me either by the Australians on Tuesday or by the New Zealand by Wednesday. So I'm happy to have a look at it. One of the two will be coming in weak. So I'm keeping an eye on oil. We have supply coming in. We have a strong dollar. That's all leading to a weakening oil market, and in response to that, a weakening Canadian dollar. And then on top of it, if on Friday the data were to come in worse than expected and the oil market is weak, that's a no-brainer to short the Canadian dollar. And without even looking at it, I would be shorting it versus the US dollar and or the Japanese yen and or the Swiss franc. Good. Dollar and the Fed. On Friday, we have majorly important CPI numbers. They are expected on a month-to-month basis to come in unchanged at 40 basis points. And the core CPI expected to tick up a little bit to 0.2 versus 0.1 prior. And then you can see the annual inflation rate here. So CPI on a year-on-year basis is expected to tick higher to 2.1, and core CPI expected to tick higher to 2.1. So that's actually bullish, and I expect rate cut expectations to get priced out or further priced out of the market if these numbers come in, as we can observe here. Recall that Jay Powell in his post-meeting statement saw weakness in inflation as, attention, transitory, and that caused the market to price out rate cut expectations. Prior to the meeting, it was almost 70% expectation for a rate cut by the Fed until the year end 2019. This morning I had a look, we're down to 57.5%. So partially explains the dollar strength, but also the dollar strength is explained by the dollar smile and is explained by the risk of mode recording the US-Sino trade war. Okay, and then the Fed's preferred measure of inflation is the PCE, and that's fallen from around on an annual basis 195 down to 155 in March. So it's going to be majorly important to see average hourly earnings to tick up, which they didn't on Friday, which caused me to make good money on a long in US Treasuries. Quite easy when you know what you're doing, actually. Traders, check this data to see any pass-through of tariffs on imports from China on affected products. So that's why we're actually looking deeper into this number. We know, okay, furniture is being tariffed, solar was tariffed. We look at each individual component to see, all right, what are firms doing? Because rest assured, what Trump is tweeting, that the Chinese are paying the tariffs, is wrong. It's a lie. It's fake news. What he loves to proclaim towards others is exactly what he's doing himself. That is not true. Reuters published research piece this morning. Bloomberg published another one last night explaining exactly that that's not true. It's a combination. Some of the tariffs are being paid by Chinese. Most of it is being paid by the US consumer because the increased costs are being passed on, and some of it is paid for by the US producers on reduced margins, profit margins, i.e. their costs have increased, okay? So annoys the hell out of me that this guy is so unspecific, yeah? And so, I don't know, it's just not, well, the markets are being manipulated by everyone and everywhere and everybody, so why should he be any different just because he holds the seat of the presidency? Possible trade opportunity for today. I'm looking at shorting the Aussie versus the Kiwi. Woo! Completely contrary to popular belief, I know, but I'm aggressive and that's what I'd love to do, and I'm looking to short it. My expectation is for a cut in Australia based on their mandatory inflation target, and my expectation is for no rate cut in New Zealand. Even if they were to cut as well, my trade may work out, okay? So keep that in mind. Even if both cut, my trade may work out. Even if both don't cut, my trade may work out if the trade war starts to intensify. The risk to the trade is that the cuts come different from my expectation, but I just already alluded to that. So I'm looking for a steeper retracement into liquidity around 105.80. My take profit is slightly above the big figure of 105, the figure, and my stop loss is 106.17. Risk to reward 221. Great. I see no questions. That means be merry, guys. Go out there and make some pips. I wish you a great week. Lots of my traders will probably stay awake for the RBA and the RBNZ, so I'm happy to trade that with you guys. I think we're going to make some good money, and then we have a further opportunity on Friday with CPI out of the US and then the employment number out of Canada. And in between, we'll just trade oil. All right. Thank you very much for showing up. Thanks to Admiral for the opportunity. Thanks for my traders supporting the business, and thanks for everyone from the outside to having a look. Hope to see you again next week. I wish you a wonderful week. Hopefully you'll make a solid return on your investments. Enjoy this business. It's very enjoyable. Every day something new. Every day we learn something new. Greatest business in the world. Thanks for tuning in, and see you all next week. Bye-bye.
Thank you very much, Jay. Thanks for the comprehensive analysis. Thanks to you guys for listening. I'm sure you enjoyed today's webinar. You can review it anytime on YouTube. Just give us a second to upload it. Thank you very much, guys. Have a good week and a good day ahead. Bye-bye.